Without further ado, I'm going to introduce nonprofit financial advisor, all-around wonderful human and friend, Cheryl Bean.
Hi, good morning. Kelly, thank you very much. For those who may not know, I spent a number of years at Sunflower Foundation, so I do consider Sunflower staff my friends, and it's great to be here with you guys this morning. So today we're going to be going through Nonprofit Financials 101. It is a very basic level 101 introduction to some financial terms and concepts and that sort of thing. So just to get started, just a quick disclaimer, this is for educational purposes. I'm not here as a CPA, tax advisor, attorney, anything like that. So it's for educational. I'm not going to try to give specific advice on specific situations. So a quick review of the agenda. Why are financials important? We'll talk about that a little bit. Types of financials and their purposes. There are internal financial statements and external financial statements. They're very different, but they correlate together. A few types of statements there, statement of financial position, statement of activities, budgets. We'll talk a lot about audits and the IRS Form 990. I did a session yesterday on audits, so for any of those of you in the room that were there yesterday, I apologize, there's some duplication here. We'll talk about fiscal sponsors, why they're important, how to work with one, what their role is, etc. I'm sure you often wonder, what do funders really look at when you are asked for your financial statements and budgets and that sort of thing? So we'll spend some time looking at that as well. I'm the type that if you have a question along the way, please let me know, please interrupt. Don't wait until the end because we may be moving on from a subject and I don't want to lose that thought if you have a question. Okay, so the importance of financial statements. If I were to ask any of you in the room, tell me about your organization. You guys are experts in your field. You can tell me about your mission, who you serve, the types of things that are happening in your community. But financials also tell a story of your organization, and they should correlate. Sometimes there's a little lag, so if you're telling me that you're ramping up in different program areas or that sort of thing, that might not show on the financials yet, but the two do correlate. Why are financial statements important? Financial statements report financial transactions for a specific period of time. That's really important. So on your statement of financial position, they're as of a certain date. So it can be a month end, it can be a fiscal year end, quarterly, that sort of thing. They track and monitor revenue, expenses, and cash flow. It's really important for you to know where your revenue is coming from, how much it is, and where your expenses are, as well as the money coming in and out. Because if you have expenses coming up but you don't have the revenue to cover it, that's a problem situation for your organization. It's really important also for you to track and understand your operations and the financial performance of your organization. This allows boards, your CEOs, any of your staff to make informed decisions. So for example, if you need to hire more staff and you don't know what your financial situation is, you don't even know if you can afford new staff or if you want to expand programs. Financial statements are critical for audits. We'll talk about that a lot more in depth later, but you cannot go through an audit if you don't have good financial statements. And then it's also important in securing external funding. Again, if you're applying for a grant to an organization, they're going to ask you for your financials. They're going to ask you for your audit. They're going to ask you for your 990. You may not have all of that, but they're going to ask you, and it's important for you to be able to talk about it and show them what you do have in an organized manner. And in some cases, you might be looking for a loan or external funding from a bank of some sort, not just grants. It's also really important, in my opinion, for your staff to have an understanding of the financial statements. Maybe not the nitty-gritty in every transaction, but they should have an understanding of your budgets, where your money's coming from. It just helps them do their job better if they have some baseline level information. And it's really, financials can be really intimidating, but it's really important that you just try not to be intimidated in learning about your financials. Ask questions. People like me who have spent years being a CFO and you dig deep into the financials, we love talking about them. Okay, so there are different types of financial statements. There's internal and external to begin with. Your internal financial statements are more of your management reports, things that your CEO, your CFO, your boards are going to be looking at. These could include your budgets, more of your management reports. They're going to be more detailed. So, for example, in your budgets, in your financial, like your profit and loss statements, you might have a section for staff. You're going to have salaries, your benefits, payroll taxes, and that sort of thing, but they're pretty detailed out line by line. Whereas in external financial statements, these are more for your audit, grantees, banks, IRS, those types of things. They're going to be more summarized. So you might have, instead of salaries, benefits, payroll taxes, and all those multiple line items, you might just have staff expense. So they're more condensed, more summarized. The one thing that I want to make sure that I'm crystal clear on is when we have internal and external statements, they should still be correlated. I'm not suggesting that you have two sets of financial statements for your organization. So we kind of talked a little bit about budgets and financial reports. Budgets are your organization's plan for the year or possibly a future year. It includes assumptions, and it's based on your goals and plans for your organization. So are you wanting to expand programs? Do you need to contract programs, shift, those types of things? Those are things that you're going to see in your budgets. Internal financial reports, again, are your management reports. They're your most current financial reports. Those are the things that you're going to present to your boards, your finance committees. They may not be fully adjusted, and that's okay because things happen over month ends as long as they're not material differences or significant. External financial statements, again, are those that are going to be viewed from outside. So funders, the IRS, again, your lending institutions and that sort of thing. Audited financial statements are for your most recent fiscal year or calendar year. It can be one or the same. It presents revenue and net assets by restriction. So that's really important. If you have restrictions on your assets, if somebody gives you money but says you can only do X with it, those are going to be funds that are listed with restrictions. If your board designates assets for a specific reason, say you want to build a building, something along those lines. And then your audited financial statements, we'll get into this a lot more later, but it's going to include notes, not just the numbers. The IRS 990, again, is based off of your audited financials if you have an audit. It's only the 990 only applies to U.S. domestic organizations. It's going to go through a lot more than your numbers, though, too. There's a lot to a 990. It goes through governance. You have to list salaries for anybody over a certain level. It gets into grants. There's a lot more than just the financial information. Any questions before I keep going? Awesome. So the types of financial statements, especially that you'll see in your audit, and then also that you should be presenting to your boards. The statement of financial position, you might know it as a balance sheet. Some of these terms are kind of simplified, but it's really what do you own and how much do you own? How much do you own? How much do you owe? And then the balance, of course. The statement of activities, otherwise known as your income statement or your profit and loss statement, it's really what are you making, your revenue, and what are you spending, your expenses. And then the statement of cash flows is probably one of the least understood statements, but it's really important because it reflects your cash in and your cash out. Most statements are generally done on a GAAP basis, generally accepted accounting principles, versus a cash basis. If your statements are done on a cash basis, the cash flow is less important, but your audited financials are always going to be done on GAAP. So the statement of financial position, what do we learn from that? The first thing in a statement of financial position are your assets. What do you own? It includes your bank statements, fixed assets, land, your accounts receivable, anything that you have title or anything that you own. Typically, there are various classifications of that. Your current assets. Those are things that are readily made into either cash or readily made into cash. So like certificates of deposit, savings accounts, that sort of thing. If you have long-term investments, those are not considered current because they have a longer time to turn them into cash. And then you have fixed assets, which are the things that you own as far as IT, your computers, land, those types of things. And then it could also include intangibles if you have patents and those types of things, which are less common with nonprofits, but those would be found under assets. The next section of a statement of financial position are your liabilities. Those are the things that you owe someone. So it could be payroll that you've accrued but haven't had to pay out yet, especially if it goes from one month into the next. It could be your accounts payable, but it could also be like over your long term, it could be loans and those types of things. And then the difference is your net assets or your equity, and those are again listed unrestricted or with restrictions. We have a question, if you could wait for the mic.
Hi, good morning. Is the organization's website considered a liability because it's a monthly payment, or is it an asset because of the content on it?
That is a great question. I would say that the content, the development, is an asset. You have outlaid probably a significant amount of money up front, and it has a life to it. So that would be considered an asset, but you also have to recognize how long is that asset valuable. I don't know how often people change or organizations change their website, but it might be a 3-year life. It might be longer, it might be shorter, but you would depreciate those expenses out then. But then you also have the monthly expenses of hosting it and that sort of thing. So, excuse me, those would be your expenses. Does that help? Awesome, terrific question. Anybody else before I keep going?
Thanks. So you had mentioned the cash basis versus that GAAP. As a small growing nonprofit, we started in the cash basis. How do we know when to move to GAAP? Because it's a much more complicated process for someone who does their own books. As a small nonprofit, we don't have an accountant.
Sure, that's a great question. I'm not sure that there's a solid guideline as far as, if you hit this target, you should be using GAAP. I will say if you go through any kind of formal process, whether it be an audit, a financial review, or something along those lines, your financial statements will have to be translated to GAAP. Most of the time, if you're using something like a QuickBooks or something, you can easily make that transition. But it's a transition in how you process information too. It's kind of scary at first, but once you kind of make that transition, it's not too bad. Does that help? I'm sorry, it's not more concrete, but yeah, it's a little process. But again, I go back to, financial statements and financial information, that sort of thing. It is scary if you don't have the training, if you don't have the background, but it's also really important. It's just important for your organization's health, because if you don't have the strength of your financial statements and understanding, it's really hard to do your programs and your other everyday work. Any other questions? These are great questions. Okay, the statement of activities, again, a little bit of summary information here. Revenue, expenses, and then the difference being your net income and hopefully not a net loss. Revenue is all forms of funds that you receive. Donations, grants, fundraising. It can also include non-cash gifts. So if you get an in-kind donation of something, you would also list that as revenue. And these are either restricted or unrestricted. Restrictions, again, are when your donor gives you funds to do a very specifically identified funds. Expenses are how much you've spent or incurred. Again, incurred being your GAAP type statements, not just the money that you've actually spent out. And sometimes these are organized by functional expenses. And when I talk about functional expenses, it's program-related expenses are identified separately than your overall organizational expenses. And it's really important to understand how much your programs are costing, because if a program within your organization is losing you money all the time, it's really important to know that. It doesn't mean that you won't continue to do it, but you have to know that so that if you need to make changes or you know you need to make up that difference, you're at least more able to make informed decisions. I have a question.
The statement of activity is also the equivalent of what is often referred to as the profit and loss budget, the budget and profit and loss, correct?
It's either your profit and loss, income statement, statement of activities. There's a lot of terms there, but they're all the same thing.
Okay, that's what I just wanted to verify.
Yeah, I apologize. That was on a previous statement, and I should have put that on here. So, absolutely. And some of these differences are just the difference of a nonprofit versus a for-profit. Net income and net loss is probably not even the most accurate because that's more of a for-profit term. It really is more of your change in net assets. So, but yeah, they're one and the same. Okay, statement of cash flows. Again, this is a really critical report for organizations that use GAAP accounting principles. It's your cash in, your cash out. And there's three main components of a cash flow statement: your cash flow from operating, cash flow from investing, and cash flow from financing. Operations are your day-to-day activities, what it takes to run your organization. Your investing activities are anything cash from investments, whether you purchase it or sell it. It's your interest and those types of things. And then financing activities are sale of assets, repayment of loans, those types of things. So most of your activities probably going to fall within your operating activities, but there are these three main components. Again, these cash flow statements help organizations make decisions about your future, or the organization's future. If you want to expand programs, again, you have to know where your cash is and whether you're able to do that from a financial position. Your change in cash flows should be positive on a regular basis. There are going to be times when it's negative, but on a regular basis, you should have positive change in your cash flow. Okay, budgets. Before I move on, any other questions? Terrific. So budgets. Oh, sorry, go ahead.
This might not be the exact time for that, but for something like a line of credit that's pulled down, and that's drawn on, then that would show positive as a cash flow, but then you're still showing the liability of that line of credit. So does that just reflect that on different parts of different budgets, or would that all show on cash flow?
A line of credit would show on your balance sheet. It would show as, if you've drawn on it, it would show as cash that you've brought in as well as the liability for what you owe. But then it's also going to hit your cash flow statement as money coming in again. But then it also is going to show as revenue and then the correlating expenses. So these financial statements are very tied together. I think that's the key, is they're very interconnected. Any other questions? Okay, budgets. I personally feel like budgets are a critical component of an organization. They really help you determine what you can do within a fiscal year or calendar year. They're really hard to develop, though.
What's the best practices for budget for like tracking for like how many years should you keep or have like to make the next or New Year's budget?
Okay, so I'm not sure I understand the question. Are you saying how many years out should you budget?
No, I'm trying to find out or determine the best practice for when I'm developing for this year's budget. How many years should I be looking back?
I think the answer is it depends on if you are doing the same thing. So like if I've had program X within my budget and it really hasn't changed, a year or two probably. If you've had significant changes over the years, you want to know those trends because it helps you budget better. So I'm not sure I could answer like it should be 1, 2, 3. I think it depends on where your organization is at, where you've been, and really, as importantly, is where do you want to go. To that point, though, I find budgets really hard to develop because they're projections. They're based on your organization's goals, and it's sometimes really hard to know where your revenue is going to come from. You have really great ideas of what you're going to apply for a grant or something like that, but some things are just out of your control, which makes it really hard. But they are projections for the year that you're budgeting for. But that's why I also think it's really important to have one, but then you have what's called a budget versus actual. So you take your budget, and then as you work through your year, you're going to look at what you're actually spending. So if you have budgeted X, but by month 3 of your year, you've spent 80% of that, you need to know why and what adjustments you can make. Maybe that's okay. Maybe you had front-loaded expenses, but it's really important to understand where your money's going within that budget. Okay, so we've kind of talked about some of this. It's predicted estimates of income.
Yes, one of the things I found out about the budget is that when you're applying for grants, it's okay to do your budget, submit your budget. But if you're applying for $300,000 and they won't give you $100,000, you got to adjust your budget.
Absolutely.
And so it's just like you said, a projection. You hope to get this money, but it's no guarantee that you're going to get the amount of money you asked for.
Exactly. And that's what makes budgets really tough is, you may not even know about a grant opportunity until halfway through your fiscal year as well. So I think you have to do your best with the information that you have when you start the budget process. But they are projections. Kelly, there's another question.
I'm coming. Oh, sorry. Come from the other direction. I am in the healthcare world, so our budget varies immensely by a cost report. So when you're doing funding, how much do they look at because it varies so much by, if you get your settlement from CMS, if your cash flow may be awesome 1 month and nothing the next month. Sure. Versus in your budget the same way. How much, when you're looking for funding, when you're sending in those statements?
So that's a great question, and I will talk about some of that later in the what do funders review and why do we ask for financials and that sort of thing. I would say, for a general sense, funders are looking at trends. We're not looking at month to month. We're looking at 2 or 3 or 4 years as a whole in a summary basis, not month to month. That's going to happen. So. Was there another question, Kelly? I'm sorry? Okay. All right, so when you start looking at your predicted estimate of income, there are certain things that you're going to know, like the grants that you've already received. Those things are that are kind of already set. And the steady income, there are also income opportunities that we've talked about. So it's just doing your best to predict what's going to happen in your year. Predicted estimate of expenses. We'll talk about that a little bit more coming up. But again, some of those can kind of flow with the grants that you're receiving, because you might be applying for a grant that specifically you're hiring additional staff or taking on additional expenses. So some of those expenses might change with your revenue as well. Budgets are based on historical data, which we've kind of talked about, looking back a year or two. But then also, what are your anticipated financial goals, which we've talked about a little bit as well. As far as the historical data, there are easy parts of a budget, like what is your rent, what are your staff expenses, those types of things. It's the others that kind of ebb and flow with your anticipated funding that become more difficult to budget. Why a budget's important, we've kind of talked about some of these as well. It helps you manage funds in a more effective way. If you don't have that roadmap and you can't turn on your headlights, you're literally driving in the dark. And without that, it's really hard to know when to spend money, how to spend money, where to spend money. And oftentimes you overspend money if you don't have that budget. It really helps board members understand not only the direction of the organization, but it really helps them understand what your organization is doing, the programs of your organization, and that sort of thing. And they have a financial responsibility to your organization to understand that and help the staff manage those resources. Creating a budget. We've kind of talked about some of this as well. I'm sorry, I'm kind of filling in gaps in different places. But you really should start by determining what are your financial goals. Look at the past years for financial performance, yes, but then also look at ways that you can, what are your opportunities for other funding throughout the year? Are you going to plan a major fundraising activity or something along those lines? So there are fixed expenses versus variable. I kind of talked about that as well. You know what your rent is. You know what your staff expenses are. Some things just don't change very much, your office supplies, et cetera. But there are some things that do change over time. Again, as you take on programs, expand them, maybe you've shifted completely away from a program and starting something new. It's really hard sometimes to know what those program expenses are going to be. Budgets help you strategically allocate those resources. The one thing I will say is just don't overcomplicate the process. Budgets are hard, but if you kind of start with what am I going to bring in, where am I going to spend it, and kind of start to fill in the gaps from there. There are lots of templates out online if you've never created a budget. There are lots of templates out there. Just don't overcomplicate the process. It should be something that's easy to understand and easy to follow for you to work with as financial staff, but then also for your boards to understand. Budget expense categories. There are different expense categories within your expenses. Your operating, which is going to be your rent, staff, office supplies, et cetera. Your administrative expenses. It's your overhead, your legal, your accounting, those types of things, IT expenses. But then program expenses are usually detailed out separately. Again, it's just so important to understand where your expenses for a program are, because if you don't have enough revenue coming in to support those, your organization really needs to understand that. Fundraising is usually separated out on your budgets. It will be separated out on your audits and your 990s. So if you can start tracking that within your monthly financials, it's just going to help you as you close out your year and go to file your 990. And then capital should be a separate budget category as well. These are the things that you're going to, they have a life to them. You're going to outlay money today, but you're going to expense them over time, such as your technology, your websites, those types of things. We've kind of talked about this as well. I think it's really important to monitor your budget as you go through a year and then make adjustments if you need to. The budget versus actual report is just a comparison of what you think you're going to do and then what actually happens throughout the year. You can track that by percentage or by dollar. Personally speaking, I think percentage is a better reflection for you to make decisions on, because by dollar, if something's off $5,000 on a budget line item, that may be huge and have significant consequences, or it might be just a very small blip. If you are off 10% versus 90%, that's going to show a greater risk to your organization on those budget line items. So I like percentage. Most financial softwares are going to do both, but percentages are really helpful in understanding the impact of those adjustments. It's important to understand why the variance occurred. If you've spent, again, 80-90% of your budget, but you're only 25% of the way through the year, what happened? Why did that happen? One line item that's going to happen is your audit. If you've budgeted X number of dollars for your audit and your audit happens in the first 3 months, you're done. So you should expend, close to 100% of that in the first quarter to 4 or 5 months. That's expected, but your staff expenses, if you expend 90% of your budget in the first 3 or 4 months, you're in trouble. Understanding a variance also helps you understand changes in your operations, and you're better able to project what's going to happen coming up. Some organizations make adjustments to their budget mid-year. Some leave it alone, just knowing that those variances are going to happen. It really comes down to what is your organization's policy regarding budget management. Does your board want to make those adjustments along the way and say, okay, we've hit this benchmark, so we really need to increase this budget line item, or we're not going to use this line item, so we're going to decrease it? Or do they just say, we understand that these variances happen, we want to know why, when they happen, and we're moving on? So it really comes down to what your organization's policy is. Audits and 990s. This is a pretty lengthy section of the presentation. Does anybody have questions? Does anybody want to quick refill your coffee break?
I'm interested in what type of accounting programs are typically being used by nonprofits, and if you're using a nonprofit version or a regular version.
I can only speak to, I've used QuickBooks my whole life. There's the QuickBooks desktop version, which I know is being phased out. They're going to online. If anybody else uses another software and wants to answer that, I think QuickBooks is probably your most common. Does anybody use anything else?
Part of the reason we're asking is because we tried the QuickBooks Online, and it was really difficult for a small nonprofit to do that without an expert in accounting. So we lost our expert, and that has caused issues. So we're looking for the next best option, quite frankly.
I wish I could help you more. I'm not familiar with what the software options are, to be honest.
QuickBooks is my favorite too, but I've done some demos with Aplos, and it's pretty similar to the QuickBooks desktop. I don't like the online version either, so that's probably the way we'll be changing as well. So just an FYI. And they'll do demos with you. They'll work with you. They're pretty good, but they are harassing, because they want to sell a product, so they contact you a lot. But I've heard it's very, very similar to QuickBooks desktop.
I just wanted to say, for anyone using QuickBooks, if you're switching to the online version and you are by any chance related with capers, they do not connect. So just keep that in mind, because that became a quick issue for us.
And I think with any software conversion, whether you're going to the same product like a desktop version versus the online, they're tough, because you have to map and make sure that those two data points are connecting, and you have to test it and test it and test it because you don't want your financial data being messed up in a transition like that. But they're tough whether you're going from product A to product B or from desktop to online.
I just had a suggestion for the person who was asking about QuickBooks being tough and losing your experts. We found that it was helpful in the beginning and also throughout our growth to have an accountant kind of on call, someone that I could reach out to ask very specific questions about QuickBooks, and then they would just charge an hourly fee. And I tried to just be very judicious about having that backup support.
And I think you can find people who can support your QuickBooks and or basic accounting functions without having to hire a CPA firm. There are other people out there who they might be a little bit less expensive than a CPA firm.
And just to add to that, I don't know how well you work with your auditors, but ours is amazing. And throughout the year, I can ask any questions, and they have different experts in their office. So if I'm using QuickBooks, if I have a question about a certain entry, my auditor will contact someone in their office who's an expert in QuickBooks and give me an answer, and it's free. But I know that's not every auditing firm out there, but that's just an FYI that you can talk to your auditors about.
Yes, what we do is we contract out, and they use QuickBooks. And then we do our financial review with a CPA. But the lady, our bookkeeper, she's not a CPA, but she's been in bookkeeping for a long time. And so that saved us a lot of money. But I would highly recommend, because as a nonprofit, we do so many things, and we can't do everything. So, yeah.
You're absolutely right. And I do think that sometimes it all costs money, right? But sometimes those few dollars that you spend on the front end, especially if it's for training and better understanding, can save you significant amounts of money, frustration, time, et cetera, down the road when you don't have to go back and fix things or try to figure out what did I do, or something along those lines. So.
Also, I think she covered our payroll, and you make one mistake with RS, that's penalty. So that just the liability of you doing all of that and trying to take care of that, it can be a big liability to your company. That's another reason we contract out too. Okay.
Valid point. Any other questions? Or you guys are great on the questions this morning.